In the financial world, the stock market is a stage where the unpredictable becomes predictable, and then flips back to being unpredictable again. Isn't it interesting? One moment it's all sunshine and roses with stocks soaring high, and the next moment it's a stormy weather with stocks plummeting. The stock market dances to its own rhythm, and that's part of its charm, and its challenge. Picture this. Companies are raking in impressive earnings, beating both top and bottom lines in the third quarter. The logical expectation would be a bullish market, right? But surprise, surprise, the stock market isn't playing by the rules. Instead of celebrating these robust earnings, the major indexes are closing lower. Now you might be scratching your head wondering, how can strong earnings not save the stocks? Well, welcome to the unpredictable world of the stock market. But what causes this unpredictability? Is it just the whims and fancies of the market, or are there underlying factors at play? The answer is a bit of both. There's a confluence of pressures shaping the market's behavior. For instance, let's consider the pain trade in bonds. When bond yields rise, as they have been following Federal Reserve Chair Jerome Powell's recent indication of the central bank's higher for longer stance, it can send ripples of concern through the investor community. Then there's the ever-present geopolitical risks, conflicts in the Middle East, tensions with China. They all add an extra layer of unpredictability to the market. And let's not forget about volatile treasury yields and uncertainty in the US economy. In the face of these pressures, the market seems to be holding its breath, not quite shifting its regime despite the strong earnings. It's like a suspenseful scene in a thriller movie, where everyone is waiting for the next big twist. As we dive deeper, one might start to wonder, can robust earnings really not save the stocks? The answer isn't straightforward, but that's what makes the stock market such a fascinating subject. So, buckle up as we delve further into the enigmatic world of stocks and bonds in the upcoming scenes. The financial markets are no strangers to pain, and recently that pain is manifesting in the form of bonds. Imagine being on a roller coaster, where the thrill of the ride is replaced by a gnawing uncertainty. That's what the pain trade in bonds feels like for investors. The phrase pain trade might sound like a new trendy fitness regimen, but it's anything but. It refers to the scenario where the majority of market participants suffer due to an unexpected market move. In this case, the unexpected move is the rise in bond yields. Now you might ask, why is the rise in bond yields causing such a stir? It's because when bond yields rise, bond prices fall. And who likes to see their investments fall? Nobody, that's who. This is the pain in pain trade. But the pain doesn't stop there. The rising bond yields are also causing interest rates on various loans to surge. This, in turn, puts pressure on companies as their borrowing costs increase. And when companies feel the pinch, their earnings can take a hit, which can then impact the stock market. It's a domino effect that's causing concern for investors. Add to this mix the volatility of treasury yields and uncertainties in the US economy, and you've got a cocktail of pressures that's anything but soothing. It's like trying to navigate through a storm with no compass. Yet, amidst this turmoil, some investors see an opportunity. A recession scare, for instance, may be needed to send bond yields back down. This could provide a window for investors to buy bonds at a lower price, hoping for a yield rebound. It's a risky move, but as the saying goes, no risk, no reward. So, is the pain trade in bonds a cause for alarm or a window of opportunity? Well, that's the million-dollar question. But one thing is for sure, the stock market is not immune to the pain trade in bonds. It's all interconnected in the grand scheme of the financial world. And as bonds continue to suffer, the stock market's future remains shrouded in uncertainty. Pressure in all its forms can lead to unexpected results, and the stock market is feeling the heat. Let's delve into the various pressure points currently influencing the stock market. First off, we have volatile treasury yields. These are like a game of seesaw, going up and down, and this unpredictability is causing quite a stir. The market thrives on stability, and the erratic nature of treasury yields is causing investors to tread lightly. Then, we have the uncertainty in the US economy. You see, the economy is like a giant puzzle, with countless pieces fitting together to form a complete picture. However, when there's uncertainty, it's as if some of these puzzle pieces are missing or have changed shape, making it difficult for the picture to come together. This uncertainty is casting a shadow over the stock market, causing investors to second-guess their moves. And let's not forget the lack of direction in Washington. With the political landscape being as convoluted as a labyrinth, it's becoming increasingly challenging for investors to predict the market's trajectory. Policies are constantly evolving, and without a clear path, the market is left to navigate through this maze, often resulting in confusion and instability. All these factors together create a pressure cooker situation. The stock market is like a vessel in this cooker, and the increasing pressure could lead to a significant change in the market dynamics. But here's the kicker. Even with strong earnings, these pressures could stifle the market's growth. You see, strong earnings are like the fuel that propels the market forward. However, when faced with these pressures, this fuel might not be enough to keep the market afloat. So what does this mean for the market? Well, it's like trying to sail in stormy weather. Even the most robust ship can struggle against the relentless waves and winds. Similarly, even with strong earnings, the stock market might find it hard to maintain its momentum in the face of these pressures. With these pressures mounting, even strong earnings might find it hard to keep the market afloat. When politics and finance cross paths, the results can be explosive. Welcome to the fascinating but complex world where geopolitical risks and stock markets intertwine. You see, the stock market doesn't exist in a vacuum. It's a living, breathing entity that responds to a myriad of factors, and one of those is geopolitical risks. So, what exactly are these risks? In simplest terms, they're the challenges that political decisions or events pose to the economic environment, both domestically and globally. Take, for instance, the simmering conflicts in the Middle East. These disputes often lead to disruptions in oil supply, causing oil prices to spike. And when oil prices go up, it increases the cost of doing business. This in turn can lead to lower profits for companies and consequently, lower stock prices. The same goes for the escalating tensions between the United States and China. These two economic powerhouses have been engaged in a high-stakes game of trade war chess. Tariffs are imposed, countermeasures are taken, and amidst all this, companies that rely on the global supply chain find themselves caught in the crossfire. The result? Increased operating costs, decreased profits, and you guessed it, potentially lower stock prices. But it's not just direct conflicts that pose a risk. Indirect factors like changes in foreign policy, shifts in power dynamics, and even the rhetoric of world leaders can stir uncertainty in the market. And if there's one thing the stock market isn't too fond of, it's uncertainty. So, as investors, why should we care about all this? Because understanding geopolitical risks can provide valuable insights into potential market movements. It can help us anticipate and navigate market volatility, make informed investment decisions, and ultimately, protect our portfolios. But here's the catch. Predicting geopolitical risks is no easy task. The world of politics is as unpredictable as it is complex. Today's friend could be tomorrow's foe, and vice versa. But that shouldn't deter us. Instead, it should remind us to be vigilant, to continuously learn, and to adapt our strategies as the geopolitical landscape evolves. As these geopolitical chess games continue, their potential impact on the stock market remains a cause for concern. Because in the grand scheme of things, it's not just about winning the game, it's about understanding the rules. As we gaze into the financial crystal ball, the future of the stock market appears hazy at best. It's like a roller coaster ride that's both thrilling and nerve-wracking. But let's try to decipher what lies ahead, shall we? The current market is a whirlwind of factors: volatile treasury yields, geopolitical risks, and economic uncertainty, to name a few. These uncertainties are like clouds hovering over the sunny landscape of the stock market, casting shadows on our financial future. One of the most significant factors is the pain trade in bonds, which has been driving the market. Will this continue? Or will we see a shift in the market regime despite strong earnings reports? It's like a chess game where the next move is crucial, but the outcome is still uncertain. And let's not forget the role of geopolitical risks. Conflicts in the Middle East and tensions with China can send ripples across the global financial sea. How these situations evolve could significantly influence the stock market's direction. It's like a game of Jenga, where one wrong move can cause the entire structure to topple. On the home front, the IRS is set to announce new tax bracket thresholds, with an expected 5.4% increase from last year. This change could impact the market as well, adding another layer of complexity to our financial puzzle. Furthermore, the looming question of persistently high inflation and interest rates can't be ignored. Like an elephant in the room, these issues could potentially disrupt the stock market's equilibrium. We can't predict the future with absolute certainty, but we can prepare for it. As we move forward, it's crucial to stay informed and make strategic decisions based on the changing landscape. Remember, the stock market is not just about numbers and figures, It's a reflection of our global society and economy. The future remains uncertain, but one thing is clear: the stock market is in for a wild ride. So, there you have it. The stock market, in all its unpredictable glory. We've traveled through a landscape of earnings beats that can't seem to lift stocks, the pain trade in bonds, and the ceaseless pressure points of our economy. We've navigated the treacherous terrain of geopolitical risks and peered into the uncertain future of the stock market. The journey has been enlightening, hasn't it? But dear friends, this journey is far from over. The stock market, like a complex piece of machinery, is always in motion, always changing. It's a world where even the most minute details can have a profound impact. In this ever-evolving financial cosmos, it's crucial to stay informed, to keep ourselves updated. The movements of the stock market may be unpredictable, but armed with the right knowledge, we can make sense of the chaos. We can find patterns amidst the randomness. And that's where we come in. We're here to provide you with the insights you need, the analysis you can rely on. We're here to help you navigate the stormy seas of the financial world. Stay tuned for more insights and analysis. Don't forget to subscribe to our channel for all the latest updates on the financial world. Remember, knowledge is power, especially when it comes to the stock market.